You are listening to Keystone's Stock Talk Show, episode 193. If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at Keystocks and on Facebook. And keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold. It's great to be back with you this week and to be kicking off an exciting new year. We have a packed show for you. Aaron will regale us with a review of the markets for 2022, the TSX versus the US performance, top and worst performing sectors, momentum at the end of 2022, and he'll discuss if energy will continue to outperform in 2023. I will answer a listener question in our Your Stock Our Take segment on FinTech MoGo Inc., symbol MOGO on the TSX, which has entered a restructuring plan to deliver profitability for its shareholders. The stock is down 75% over the last year, so something definitely needs to change. And Brennan proves to us that he can indeed read, who knew, by giving us some quotes from a book he is purportedly reading by legendary investor Peter Lynch in our Investor Spotlight segment. Finally, Brett handles our star and dog of the week, the latter being embattled once tech darling Tesla, symbol TSL, on the NASDAQ, which continued its precipitous slide over the past week. The stock is down 70% over the past year. The former and star of the week is little-known Canadian microcap, a name we have highlighted for the past several years in our Canadian cash-rich small cap report, which is due out near the end of this month. Ibex Technology Inc., symbol IBT on the TSX Venture. The stock is up 58% over the past month. Brett lets you know if it is sustainable. So let's get to the show. I'm going to welcome my co-host, Aaron, and the Killer Bees, Brett and Brennan. How you guys doing? It's a new year. Whoa, has everything changed?
Good. Happy New Year.
Nothing much.
Happy New Year to everybody out
Happy
there,
New Year.
for sure.
We'll start off looking good. Excited for 2023. See what happens. Always nice to start a year.
Yeah. Get a year older. It's amazing.
6,500 contribution to our TFSA this year. So going to be adding that ASAP.
Brennan's
personally.
losing it. He's loving it.
Yeah. Well,
so you're reading a book, Brennan?
I am reading a book.
Well,
yes.
purportedly.
Yeah.
Yes.
Is this part of your New Year's resolution?
Yeah.
One up on Wall Street?
One up on Wall Street.
How far are you in so far?
Not very far
One
on this
page.
one. Just the introduction.
Okay.
Yes.
He's read the cover.
So you started it
last
summer or what?
2 days ago. So
I'll be interested. You know, one thing we could actually do is we could do book summaries on investment books. Yeah, or book reviews, book summaries.
Yep.
Like do those as separate, maybe a little bit like a really shortened summary for the show, but then also add a 10-minute summary or something for to the YouTube channel.
I actually bought.
I know a lot of people like that.
I actually bought Irrational Exuberance. Is that the one by Schiller? Is that Schiller? I think
Schiller.
Yeah, I think you recommended that to me. I've bought it. It's sitting on my bookshelf. Haven't opened it yet. But I have been on a reading kick, though. I have been on a reading kick lately. Yeah. So I've been crushing some books, and this is the next one.
Irrational Exuberance. I mean, it's not a difficult read. But it's a thick read. It's pretty dense.
Yeah. Definitely.
Well, that fits well with Brennan then. Pretty dense. So let's. I'm reading the third Harry Potter book, so I'll provide a review of that, or I'll get my daughter to provide a review of that to everybody when we're done. Now,
this must be not the first time you've read.
Oh no, I read them all too. Or read them with Eric as well. So it was good. It's
so
good.
This is the first time you're reading them with your daughter. Okay.
Yeah, for sure. We read them, and she's actually reading them to me too as well.
She's a better reader than you now, but
of course,
I don't doubt it.
Well, I mean,
she is actually a very strong reader, but
she is pretty. She's a damn good reader, which is awesome. Yeah, I mean,
whereas you were
encourage it. I struggle at the best of times. Yeah. Right? So if it's not a financial statement, it's hard for me to read. Right? That's just real writing.
You know, I just on a side note, I actually went through a period where I wouldn't read much outside of work at all. I really got more into audiobooks. But the reason is because we do so much reading for our work, right? Like
I
going
find
through
that,
MD&As, press releases, financial reports. And I just found that after you finish a day of that, the last thing I wanted to do was look at print.
Yeah,
Right.
on a
I
page.
wanted to, like YouTube videos or audiobooks.
Yeah.
It's kind of what I gravitated to. And then, but I find it kind of goes off and on. Then you rekindle your love for print. And then you kind of get bored of it.
Yeah, I think it's pretty
natural. We do a lot of reading
like
in our work. So it's when you're reading for several hours a day for work, it's not the first thing you necessarily want to do when you get off work.
It's true. It is always good to read, but we do a lot.
I like buying the print books. You know, it's like the Seinfeld skit where George is basically saying, "They're my trophies. They're my trophies."
And displaying them, and just displaying
them. Exactly.
Yeah, of course, George never actually read any of them.
No.
That's usually people that look at books as trophies don't actually read them. They just put them where everybody can see.
About 20% of all my books on my bookshelf have been read, but
he displays them. Hey, ladies, look at these.
That's not bad. That's
Exactly.
not bad.
Yeah.
I'm an ebook guy. Like when I discovered ebooks on the iPad, I never turned back. I think it's great because my wife hates a collection of just things that sit on the shelf and don't get used, or once they're used, they do nothing. So I can buy whatever books I want and not have to explain them. But then also I just find that it's just the light from the iPad kind of gets your eyes more engaged. You can like take notes in the iPad. You can, you'll always have your book there. I've had it where I've had books that I read and I hadn't touched them for years. And then I'm doing a cleaning of my place and I'm like, I'm not going to read this thing again. And then I want to read the book again, but it's gone, right? Years later. So this way you always have them there and your notes and everything. So
for sure. So did you guys make any New Year's resolutions this year? Did anyone?
Read more books. Seriously,
back to the books. We're trying to get away from this. No,
I'm sorry.
No, it's good.
Go to the gym regularly.
That's a common one, right?
Like I was just telling the guys earlier, my grandma made a bunch of Christmas baking, and I've been absolutely crushing it. So
that's your revelation.
I've been off to
crush the baking.
I've been off to a bad start. So
yeah.
What about
Aaron?
you guys?
Anything?
I don't make New Year's resolutions, to be honest. I mean, I'll make goals for myself throughout the year, but it's not like I'm not a New Year's resolution.
But you're perfect as is, so what do you need, right? You don't need anything else, right? It's true.
It's not what Ryan was saying before the camera turned on. But
Brad,
anything? Not what I hear he's been saying behind
Brad?
my back.
No, Aaron's been rubbing off on me too much. Yeah. I keep saying this. It's a bit disturbing at this point.
Yes.
What's that? What's disturbing?
You're rubbing
more
off
and more like you every day. Yeah.
More and more like me.
Yeah.
End it right now.
All
right, let's get into the show. No one cares about our resolutions.
Brett's on a bad path, man.
Yeah. Ryan's gonna stop complaining about the Canucks. The Canucks. Anyways,
stop complaining. I'm gonna start complaining more publicly. Maybe write a blog or something. That's. So, Aaron, you want to do a review of this past year and looking a little bit?
Sure, why not? I'm going to inundate everybody with a bunch of charts. What do you guys?
Oh, thrilling!
Think about that?
Do it.
Yeah, just.
Do we have to read any of them?
No, I'm just going to walk you through. It's going to be quick, but I just figured, we're at the start of 2023. Why not just take a look at the market performance over the past year?
And for the people on the podcast, Aaron will explain them. Eric will explain these charts that he's got on there, right?
Yeah, sure. I mean, it's you could easily follow along just by the explanation. It's not a big deal. But anyway, so I just want to take a look. Home country index, the TSX index. How did it do in 2022? So overall, the TSX index was down 8.5% for the year. So not a great performance, obviously, but when we compare this to the U.S., it actually does look pretty good. So looking at the S&P 500, down 19.4%, so almost 20% for 2022. And why is this significant? Well, this is significant because I think this is the first time in 10 years that the Canadian index has outperformed the US index. And I could be wrong. Maybe there's 1 year in the past decade where it's outperformed. But generally, we've been a perpetual underperformer relative to the US. Now, of course, our 1 year of outperformance doesn't actually mean we generate positive returns for the TSX, but this is still a deviation from what we've seen over the past decade. And one of the reasons why this has been the case, and this is a systemic issue with the Canadian market, is that we are highly concentrated up here in Canada. Resources, banks, or financials, those two sectors alone generally account for about half of our stock market. And in the financial sector, most of that are the big six banks, right? But very highly levered to oil and gas, which has not performed well for most of the last decade, but did perform well over the last year. Whereas the US, highly levered towards technology, which has performed very well over the last decade, but not over the last year. Now, the S&P 500, that's a wide mix of companies. But if you want to look at the NASDAQ in the US, this is the tech-heavy index. This is where most of the tech companies are located, is in the NASDAQ. NASDAQ was down 33% for 2022. So that is an absolutely horrid performance. And that comes down to major underperformance, primarily from the technology sector. Now, 33% doesn't even really tell the full story. We've talked about some individual companies, some of the companies that were the top performing names over the previous couple of years, like the Zooms, the DocuSigns, really strong pandemic stories. A lot of the high growth, mid cap, SaaS stock, software as a service software companies. Many of those names are down 70, 80, 90+% in 2022. So it had been a absolutely disastrous year for the technology sector in the US. Now, let's talk about some top performers. Well, of course, energy has been the main focus in the past year here. And because it's essentially energy is the reason why the performance of the TSX was not worse than the 8.5%. It really boosted it. So TSX Energy Index was up 31% in 2022. Absolutely great performance there. Whereas the technology sector in Canada was down 29%, right? So this is Canadian technology down 29%. Now, the top technology company in Canada, being Shopify, was down much more than that. I don't know, Brett, if you want to pull up the 2022 decline for Shopify, just so we could have it at some point in the conversation here. I don't have it handy, but Shopify was at one point, I believe, the largest stock by market cap in the Canadian market. I think it was about half or more of the entire technology sector. And this goes once again to the high concentration that the Canadian market has on a number of different levels. But Shopify's performance, while I don't have the specific number, was absolutely horrid.
Minus 67% over the year.
Minus 67% for the year. And, this was, I believe, the largest company by market cap in Canada at one point, bigger than even the big banks, and essentially dominating the Canadian technology space. But technology actually was not the worst performing sector in Canada, surprisingly. I thought it would be. It was actually the healthcare sector, the healthcare index, down 56% in Canada in 2022. Now, I think that, the Canadian healthcare sector, or the index rather, it's a bit of a strange index because we don't have a lot of, what you would consider to be traditional, conventional healthcare companies in Canada that are publicly traded like they do in the US for a variety of reasons. So the healthcare sector overall, or index overall, is very small relative to other sectors in Canada. And in addition, our cannabis stocks are also considered healthcare companies for the purpose of the index. So this index does include Canadian cannabis companies. Personally, I don't understand why they would be in healthcare. Most of them are selling primarily into the recreational cannabis market, which to me is a consumer product. It's not a healthcare product. If they're medicinal, I can understand healthcare. But anyways, down 56% in 2022. And then a look at the US Technology Index. So this is the S&P Information Technology Index. So down 56% in. Sorry, that is wrong. I have a wrong number there. So can you just work the number for me here, Brett? It ended the year at 2139 and started at about 3100. Can you work that percentage for me? Yeah, sorry, 56%. That was from the previous slide, but still a major decline
down 31%.
Here. Yeah, we're looking at about 31% decline U.S. technology index. Sorry about that. And then I felt as well. I mean, these numbers that I've shown you, they really cover the entire year. But I also felt that maybe it'd be a good idea if we looked at just what sectors had the most momentum coming out of 2022, because a lot of people will make the presumption that if a sector had really great performance across the year, that meant that it performed well in the latter part of the year, and maybe it has good momentum going into 2023. Not really the case. If we take the top performing sector, energy in Canada, performance over the last 6 weeks of the year, the sector was down, the index was down 12%. So that great performance that we saw throughout the year did not translate into strong momentum going out towards the end of the year. Now, 6 weeks, that's a fairly arbitrary number, but essentially what it just shows is that the sector was, the momentum really died down towards the very end. And then if we look at one of the worst areas of the market, so the NASDAQ 2022, last 6 weeks, still not great, but not as bad. So down 8.5%. So a little bit better performance than energy coming out of the year. Now, what does this mean? Well, it doesn't really mean anything. This is just informational. But I'm sure a lot of people are wondering now, okay, 2022, that's in the rear view. What are we looking at for 2023? Can we still expect technology to underperform? Can we still expect energy to outperform? Well, I would be cautious on an expectation that energy will continue to outperform in 2023. Now, this is not a prediction. It's just a concern. So if we were to look, for example, at crude oil prices, this is like a 1 year chart. We're basically ending the year roughly where we began, at about $78 per barrel of WTI. That's down from a peak of $115 to $120 per barrel. So in the last half of the year, really, the momentum on commodity prices, energy commodity prices, was not very strong. And the same statement can be made for natural gas as well. Really volatile throughout the year, basically ending the year where it began, about $3.94 for natural gas. And that's down from about $9.50 at the very peak in September. So the last several months, weak momentum for natural gas. Now, these commodities are also very seasonal. I'm not adjusting for seasonality. That needs to be considered too, but it's just something to consider when we are looking at which sectors are going to outperform in 2023. Rather than trying to make a guess at which sector is going to outperform, we have our own strategies for picking winners, and that's to be more or less sector agnostic. Look at the individual companies and build that portfolio that has a mix of different types of companies in strong growth areas. So, technology is going to be one of those areas, but we've seen what happens when you completely lever your portfolio to technology. So it's an important part of the portfolio. It's not all the portfolio. Some people are going to want to have commodity exposure in there as well, energy, natural gas. But given the volatility in that space, we suggest that exposure is controlled and moderated, and you're not overexposed to highly cyclical sectors.
Totally.
Excellent. Oh, and just another comment just on energy as well. Just given that it got so much press this year, over the past year, for the great performance, when we look at how energy has performed over the last 10 years, it's really almost negligible return. I mean, a lot of volatility, but it ended a great year in 2022, roughly where it was at the end of 2012, with a lot of volatility in between. And if we didn't have this last bull run, previous to this year, it was almost straight down. So that just illustrates how volatile the space can be. Again, having some exposure to it, good idea. Having too much exposure to it can be disastrous. Excellent.
Perfect. Yeah, like I'd like to say,
yeah, I mean, just on yeah. What do you want to go? Well, just on the energy and. Okay,
let
go,
Brennan talk,
Brennan,
because he started first.
Well, no, it's Brennan. Just Ryan and myself talked about this yesterday. We literally had this conversation saying, we're seeing oil back to, levels which were at the beginning of 2022. Mm-hmm. They went, they were elevated throughout 2022. Going into 2023, if oil just remains in the exact same position that it's going to be, these companies are going to have difficult comparables to report against. So, revenue is likely going to go down, and earnings are likely going to go down unless they can increase production. So, going into 2023, if we continue to see oil in this range, there's going to be tough comparables and some tough financials to post against. Maybe not as much growth, or maybe no growth that like we saw in 2022. But anyways, sorry, Ryan, I cut you off twice.
Yeah, I would just, over the last several weeks, and even during the course of the ending part of 2022, we've had a number of clients and potential clients reach out and say, should I be in energy? I should be all over energy. It did well last year. And like, chasing a sector like that is often a fool's game. And, we just saw those charts. Like, many of those companies, unless we see seasonal jump ups in the price, like natural gas is down over 50% in the past, over the last half of this year. And it's dropped precipitously just in the last month. So you're going to compare those numbers. If natural gas stays in its current range, which is one of the possibilities, if it goes lower, if it does two of those things, the year over year results will be very poor relative to where they were last year. If it goes up, it has to go up significantly again. It can start to compare, or maybe start to be above. So that's one scenario. Only if you have a significant increase from where you are in either oil and natural gas, with a commensurate either equal production or higher production, that's when you will get better results, which will drive the stock higher. But in two scenarios, essentially flat or going down, you're going to see significantly lower results in these companies year over year, which, we don't know which way it's going to go. That doesn't sound like the greatest bet to me. And you are just betting on the price of energy. And if you look back at energy, like Aaron said, over 10 years, those stocks are actually lower than they were at this time 10 years ago. So, if you look at, if Aaron had the information technology, he's put that up before, that sector, despite the losses that we saw there over the past year, it's up significantly after the past 20 years, for example. So even after the losses we saw over the past year. The last thing I'd say, can you guys tell me the index in North America that actually underperformed all of those indexes that Aaron put up? Can anybody tell me that?
Venture.
There you go. The TSX Venture down 39% over the past year. A very impressive performance for that index once again. Maybe I can get in a fight with the CEO of that index once again, as I did after a speech on that exchange a few years ago, just prior to COVID. So maybe we'll tweet that out there with the performance of that index over the past year. When commodities, which, there's a lot of junior commodity-based businesses on there, did relatively well, at least for part of the year, it had a very poor year. Okay.
Just on your comments on the NASDAQ there, so technology index. So, you're looking at about 250% return over that period of time.
Yeah.
From the NASDAQ.
Tremendous, right?
Index. And that includes the big drop that they had over the last year, right?
As opposed to you putting your money to work in energy, for example, over that period, a negative return, right? So, 1 year does not a sector make, or an investment philosophy make. I wouldn't base your investment philosophy on what a segment of the market did in 1 year. So let's move on to our next segment. We're done there. Aaron, you're done? Nothing else? Okay, good. I'm going to look at our Your Stock, Our Take. A question came in on a company called MoGo Inc., symbol MOGO on the TSX. We've interviewed this management team. They're actually from Vancouver. We ended up talking to them in California at an event. The stock price is 82 cents. Stock is down 77% over the past year and over 94% since its 2021 highs. Market cap is just under 62 million. There's no dividend here. The company, I'm going to describe it. They're a fintech company. They state they have 2 million members, which they assist with simple digital solutions to get control of their financial health. They have a free app, the MoGo app. Consumers can access a digital spending account, get free monthly credit score monitoring, and ID fraud protection, as well as personal loans and mortgages. The company also owns MoGo Trade, And that app offers commission-free stock trading, and together with MoGo, their wholly owned subsidiary, brings automated, fully managed flat fee investing to Canadians. Well, let's look at the good here in terms of the recent financial results. Revenue was up 12% year over year. Members were up 17% year over year. Adjusted OPEX, or operating expenses, were down 24%, and adjusted EBITDA was up 32%. So the member growth here, if you look back to Q1 of the year, or Q3, sorry, of last year, it was at about 1.77 million. It's at 2.21 million as at Q3. So year over year, significant growth there. There's cost savings. An initiative was put forward to restructure, and cost savings initiatives have been going forward with this business. They drove improvement in OPEX. OPEX was down 24%. And adjusted EBITDA, again, improved 32%. The okay here, after the bad, is the balance sheet. As at September 30th, in their presentation, MoGo states that they hold 106 million in cash, investments, and digital assets. On the balance sheet, we see 35 million in cash. That is down from 69 million at the start of 2021. So that's quite a decline. And under investment accounted for using the equity method, we see 56.13 million. That's down from 103.82 million at the start of 2021. This is basically the company's strategic investment in CoinSquare, one of Canada's leading digital asset trading platforms. We've seen trading volumes are down significantly even since September, and I will guess here that there'll be another write down in the value of this investment coming soon. The company also has 47.7 million under a credit facility and 39.69 million in debentures. The credit facility is at a variable rate and now substantially higher rate than at the start of the year, last year. It's subject to certain covenants and events of default. So as at September 30th, I'll make it clear, 2022, the company was in compliance with these covenants. But if asset values on the balance sheet continue to drop and cash flow is negative, it is something to watch. Not in trouble as of the last report, but something to watch here. The bad here. Well, we said adjusted EBITDA was up, but it is still negative for the last quarter. Negative 2.8 million in adjusted EBITDA. And the adjusted net loss was 8.4 million. As at the end of Q3, MoGo has an accumulated deficit of 239 million. So our take here, startups are great, and new tech and growing a user base takes a great deal of time. But at some point, a company has to start generating cash flow and operate off of that cash flow. MoGo is not a terrible venture. In fact, it is admirable the company has been able to generate 2 million members. But those members need to be monetized into a profitable model. Otherwise, for shareholders, what is the point of the venture? MoGo currently has its restructuring plan. It's focused on accelerating the company's path towards profitability. This is good, but with this plan comes an expected 10 to 15% impact on quarterly revenue in the near term due to cost cutting, essentially. So without the constant spending, growth suffers. The question is, was the company just buying growth in an easy money market with a business model that is not that profitable, if at all? The market is clearly stating they're skeptical. There is likely some value here in the customer base and the tech, and perhaps MoGo is purchased on the cheap at some point, but we do not invest based on that criteria. We will monitor MoGo's restructuring to profitability progress, but prefer to invest in cash flowing growth businesses at reasonable prices versus cash flow negative business with the hope of future profitability. Just too much risk and not enough upside. We find more upside in the businesses with the other profile.
Yep.
So anybody want to discuss that?
Well, we followed MoGo more closely a couple of years ago. We actually met with the CEO when we were at a conference in Los Angeles. And
yeah,
I believe that they, at least on an adjusted basis, at one point, it looked like they were becoming profitable. They're starting to look a little more interesting. One thing that I didn't like about the business is that they were a bit of a hybrid company. They had the fintech side, and they had a side that was just more traditional finance where they had a loans portfolio. So it was, not totally simple to separate the two. I figured, either you're a fintech company or you're a loans company, basically. But we followed it in the past. It had gotten profitable for a couple quarters, at least on an adjusted basis. The stock performed well, but it's like Warren Buffett says, when everybody floats when the tide's in, it's when the tide goes out, you see who's
naked, swimming
naked, I guess. And that was probably the case here. Now, a lot of that capital has been sucked out of the tech space, out of the fintech space, and companies actually have to have real business models that are producing earnings and cash flow. So, in terms of valuing it, getting on the cheap, I don't know how you value it if it's not profitable.
Yeah, it's very difficult. And I know they've been running down their loan book, so it's not always like comparisons. But if we look back to 2018, they had 26.9 million. Then 2019 went to 34.5 million in revenues. Then 2020, 25 million. Then 2021, 23, now trailing at 26.7. There's actually not a ton of growth there. Now, there may be growth in the fintech outside of the loan side, but it's still a relatively small revenue base. The valuations it achieved when the stock was in the $11 range were insane. Again, companies that grew up during that free money segment really, just didn't have a focus on a bottom line because you didn't need one. You could raise money so easily in the market. And now the whole culture of this company and many businesses that were doing this, I think I've talked about this in the past, has to change. It's one thing to be a company that you don't really have to focus on cash flow and the bottom line because you can get money so simply in the market. Now money costs more and nobody wants to give money to these companies. So they have to suddenly become a company that is minding the bottom line. How will employees like that, when their stock options aren't doing as well? How will, how does the culture
they just
of that
need to be managed more, right? Like if money is easily accessible, you don't have to manage the margin. I mean, that's a completely different corporate culture, working culture.
And everybody gets to spend when they're on the road,
counting the paper clips, right? Yeah, exactly. Yeah. And then you don't have your office parties. It's a totally different corporate culture.
And the question is, were they just buying growth? Because now that they're pulling back, CapEx spending isn't there. Do we see no growth? Do we start to see negative growth in the business? And, that's something to monitor. Again, having 2 million users is something admirable. Maybe if somebody finds that as a base they want to get their hands on, maybe one of the banks wants to buy it, but they're building their own apps as well. So, or have built in some cases. So we'll see where it goes with MoGo. But right now, there's just great businesses out there that we can find that are actually producing cash flow and growing that just have a lesser risk profile and similar upside. So I'm not sure why we would put our money towards this until they can say we can grow out of cash flow, and we can grow per share earnings. And we don't see that right now with MoGo. So we would just sit on the sidelines and monitor till they get there. Or if they don't get there, it's never going to be an investment for us. So let's move on to Brennan, where a segment where Brennan's going to prove he can read, which is impressive. Yes. So he's going to talk about, in our Legendary Investor series, Peter Lynch. Take it away, Mr. Reader.
Okay. So, yes, I can read. Not very well, but I can read. Okay, so I thought that I would do an investor spotlight on Peter Lynch because, yes, I can read. I'm reading his book right now. I'm only through the introduction, which he wrote in 2000. So this was kind of like right before we saw the fall off of the tech bubble in 2000. So it is interesting, and I thought I could kind of relate to where we're seeing valuations now, or where we were seeing valuations and whatnot. And then I'll kind of share some quotes at the end. So Peter Lynch, who is he? Here we go. He is a proponent of value investing and helped popularize the growth at a reasonable price, or GARP, stock investment strategy, which is what we follow at Keystone. And essentially, he came to prominence because he managed the Magellan, I believe I'm saying that right, Magellan Fund at Fidelity Investments. Magellan? Thanks, Ryan. Magellan Fund at Fidelity Investments between 1977 and 1990. And he produced an average annual return of 29.2% over that period, which is pretty impressive. And then as well, he is the author of a few books, including One Up on Wall Street, which he published in 1989. And this is the one that I'm reading. And this book is kind of more about his theory in value investing. He also published Beating the Street in 1994, which is kind of application of the strategy itself. and then also Learn to Earn in 1995, which is more for teenagers and getting them interested in investing. So here's a chart just showing the growth of $1 over the time that he was at Magellan. So that $1 if it was invested in Magellan, would have turned to $28.14, whereas over that same period, the S&P 500, that $1 would have only returned or turned into $6.60. So very impressive growth over that period. So I'm going to go through some quotes here from the introduction. So starting off, he says, I own stocks where results depend on ancient fundamentals. A successful company enters new markets, its earnings rise, and the share price follows. The typical big winner in the Lynch portfolio takes 3 to 10 years or more to play out. He also says, I subscribe to the crusty notion that sooner or later earnings make or break an investment in equities. And I could relate this back to MoGo. That's something that we're seeing. The risk outweighs the reward right now. If they never break into earnings, that could break the investment in MoGo. And he also says, all you need for a lifetime of successful investing is a few big winners. So I'm sure, podcast listeners have heard us say very similar statements to these before. That these are very close to our strategy because, of course, we are growth at a reasonable price value investors. So he also says you don't have to be trendy to succeed as an investor. He says most great investors, such as Warren Buffett, are technophobes. They don't own what they don't understand. And an example of this would be Sona Nanotech, which we had red flags around in 2020 when they announced that they were developing the next best rapid COVID test for testing for COVID-19, and it was due to their nano gold technology. And the stock did have a great run on speculation, but absolutely collapsed right back down. And we got comments back on the internet saying, you guys don't understand the technology. Well, you're right. We don't. And that's why we stayed away from it. We're not scientists. We're fundamental value investors, and we're not going to put our money in something based on the hope or something that we don't understand. Now, I like this quote. He says, stock market news has gone from hard to find in the 1970s to the early 1980s, then easy to find in the late 1980s, then hard to get away from. It's very hard to get away from, the talking heads on, any kind of financial news. And people are advised to think long-term, but the constant comment on every market gyration puts people on the edge and keeps them focused on the short term. He makes the point where realistically, people shouldn't look at their portfolio, for every other, 6 months, essentially. You don't need to focus on what the stock market is doing day to day. And this is kind of relating to, fundamentals around the tech bubble, essentially. He says, with today's hot internet stocks in the 2000s, when he was writing this, fundamentals are old hat. So essentially, we saw this in 2021. Fundamentals became old hat, is what he would say, with stocks trading upwards of 100 times sales and no earnings. And he also says, thanks to the internet, 500 times earnings has lost its shock value, and so has 50 times earnings. And again, we kind of saw this, just recently. He goes on to say, the .com is enough to convince today's optimists to pay for a decade's worth of growth and prosperity in advance. So as an investor, when the market gets completely overvalued or specific names get overvalued, essentially you're paying, a premium for their growth. And, it takes them, just generally, you don't want to overpay and pay, 50 to 500 times earnings for, some of these businesses, because it's going to take them a long time to grow into that actual valuation. And lastly, wonderful companies become risky investments when people overpay for them. And he uses the example of McDonald's, where in 1972, the stock was bid up to 50 times earnings. With no way to live up to these expectations for growth, the price fell from $75 to $25, which presented a great buying opportunity at a more realistic 13 times earnings. And these essentially are just his books here. And yeah, that sums it up. I just think that, He's a growth at a reasonable price investor. I'm really enjoying the read. A lot of what he says, relates exactly to what Ryan and Aaron have taught and, preach and have preached over all of these years. And if I come across any more quotes, I'll definitely bring them up on the podcast as well. And any of his real life examples. He likes to use real life examples, which is good.
I like the quotes, especially when he's talking about how stock information became easy to access in the 80s and then hard to get away from. And I imagine that's he's talking like in 2000 around, right? So imagine like he wasn't even like fast forward to now.
It's 10 times what that was.
It's 100 times. I mean, social media, more people on the internet. It's just people are absolutely inundated with information about unlimited things all the time. And the problem with that is that a lot of information creates the illusion that you're well informed, but actually in many ways it can also do the opposite because you become overwhelmed with the information. You're constantly guessing. But one question I have about Peter Lynch is, so he seems to his entire investment career, or the career that he's famous for, was between 1977 and 1990. So about 13 years. Has he done anything or said anything in the last 20, 25 or 23
Not
years?
really. From my understanding, he retired at, I believe he was only 46, I believe, in 1990. And he retired, and then he just kind of started doing his own investing and kind of philanthropy. So he does give away a lot of his money. And then as well, I believe that he's actually still with Fidelity, where essentially he kind of mentors the young analysts. Now, I don't know if he's still doing that, but
he did like George Seinfeld in the episode of in Seinfeld, or George Costanza. Sorry, he got out when he was on top, right? Remember that episode where he's like,
I was going to say,
I'm getting out on a good note, and he got
getting out on a good note because he continues to be. If you Google the best investors of all time right now, you're going to find Warren Buffett right at the top of the list. And you'll usually find Peter Lynch at number 2, but like his career was relatively short. I mean, 13 years, and that ended like 32 years ago.
Brennan, I was just going to say the Magellan Fund, it is Magellan. It comes from, do you know where it comes from, the name?
I don't. No, I don't.
Ferdinand Magellan. He was like a Portuguese explorer. He was the first credited to circumnavigate. The word so that's kind of where the fund got its name from.
Interesting. I didn't know that. I like history.
Investment fund to circumnavigate the globe.
It's funny. Exactly. I think it travels the world for great investment opportunities. He did himself, or just the fund did without him. So, I thought you'd know the Magellan because I make that quote about the 10 stocks if you like those, and he managed the Magellan Fund. And I've literally made that.
Brian thinks we listen to his speeches.
I thought at least Brennan would. I thought at least Brennan would be listening to them at one point, or because he had to edit them. Yeah, apparently you pretend well. So that's all we want on that. I mean, I think the quotes, like Aaron said, they're great quotes. Like making 2 or 3 investments that are great investments in your life can change your life. And it's true. Like I literally gave a speech without reading that book about that topic. And it is true. Like then some of the most boring businesses that you can understand, the Boyds of the world, the Expels of the world, juxtaposed against like the latest technology in Sono Nanotech or Cielo Waste, or, revolutionizing the disposal of waste. Like, how about just a business that creates a ton of cash flow that everybody needs and keeps growing with great management? Like, forget about all the other crap and just invest in those. And it's kind of what he's saying in those, and how impactful if you grab 1 or 2 of those in your entire investing lifetime can have in your portfolio. And this is when we're going through the TSX and the venture right now, and we're going through 3,000 companies in the US. When we go through all those businesses, that's what we're looking for. Maybe it's an exciting business, or maybe it's a boring little business that just keeps presenting and pushing cash flow out and has, a competitive advantage and is going to grow that over time. And we just found a really obscure company in the US that is profiling towards that. It doesn't mean it's going to be one of those ultimate successful companies in your portfolio. But if you get that company, get 15 or 20 in your portfolio that have that criteria, 2 or 3 of them becomes one of those companies that has tremendous long-term returns that can power your portfolio over the next couple decades. And that's what we're looking to do.
Even in the introduction,
finding that model of companies. Yeah.
Even in the introduction, he makes the case where it's like, you only need 50% of your stocks in your portfolio to do well and have some very strong outperformers in there in that group. And the other 50 could technically go to zero and you'd still be up essentially. I mean, it depends on what return you're getting, obviously, in those, specific securities, but, he's just making the case that exactly that 2 to 3, great.
Yeah. We literally had the real world example of a client who had taken 15 stocks and put 50,000 or in each of them. And one of them happened to be Expel. And that $50,000 investment was worth $2 million on its own. And I think the original investment was around $1 million in that range. So even if all 19 other stocks, something like that went to zero, you'd still be 50% or 100% higher in that portfolio, which is shocking. The goal is not to have all 19 stocks
and
go to zero.
Those types of stocks, I mean, they come around rarely, but they do come around, and you don't have to take.
And you're talking about maybe 2 in your life. If you can get 2 in your life, you're going to do well in your portfolio. And it's hard to get 2 in your life. Let's be completely honest with that. It is hard, but going with a profile of the stocks that we're talking about, you have a chance to do that. You don't have a chance if you're just looking for a hope and a prayer. You're going to end up with zero instead of a profitable business that can grow.
One of the
all right. Now let's,
or actually go on.
Yeah, go. What were you saying? I'm just going to move on to the next segment. So.
One of the big winners that he references over the time of in the 1990s is Dell. And it's just, that was an easy trend to follow. They were really getting profitable, and $10,000 invested in Dell in the 1990s, I believe, turned to 8.9 million, over that decade. Anyway,
that's an okay return. Yeah, it's pretty good.
Yeah, not bad.
Yeah.
Anyways,
not bad. It's amazing. Yeah. So let's move on. Star and dog, so we can get out of here. We like to do the dog first, right, and end on the star. We end on that positive note. So the dog.
It's actually dog and star, the segment.
Yeah, so it's dog and star, but somehow that sounds. Yeah, I like star and dog.
Yeah, me too.
No, it's true, dog and star. Yeah. But so star and dog, starting with the dog, Tesla really needs no introduction, but Brett's going to take it.
Yeah, we're still going to introduce it, and actually, we'll go back to Peter Lynch for a second. I really think one of his quotes, which he did say, wonderful companies become risky investments when people overpay for them. I think that's really been the story of Tesla. You always have people saying they want to invest in growth, that all the values in the future, it's all priced in. It's at whatever $300 it was, even after the split, it was still in value. But over the last year, we've obviously seen the opposite. So let's get into it. Tesla, symbol TSLA on the NASDAQ, designs, develops, manufactures, leases, and sells electric vehicles and energy generation and storage systems in the U.S. The company operates in its 2 segments, automotive, energy generation, and storage. Tesla did see a brutal 2020-22, and it has not stopped, at least for the first day of trading in 2022, falling 12% yesterday. It is a bit up today at the time of recording, and I think it was a few percent, so a bit better, but it's still absolutely just been hammered over the past month, down 41%. And at the time of when I was writing this, it was a 108 with a market cap of $339 billion. Tesla's drop over the past year, as well as specifically the last month or two, can be attributed to, I found, 3 factors: macroeconomics, weakening delivery performance, and of course, the ever so visible CEO Elon Musk's actions. First, let's go over the macro conditions, which normally I wouldn't really touch on these for an individual stocks, but I'm specifically highlighting these because the CEO Elon Musk highlighted them, and he attributed the high interest rates. So when high interest rates are starting to shift from the low to the high, you'll start to see valuations go down. This is due to a somewhat technical factor. When you're comparing 2 things, let's do a bond versus a stock. If you can get, let's say now 4% from a bond, when before you're getting effectively maybe 1% from a treasury at best for quite a while, you're going to shift to the bonds because it's lower risk naturally. So you have to get a higher return from the equity. So in Tesla's case, since a lot of its growth was down the line with its high valuations when it was at 50, 60 PE or even higher at times, now all this future growth has to be discounted at that higher rate. So we add in that higher discount rate. So, or you can just think of it as an interest rate, and it'll create a lower valuation. This is what Elon Musk highlighted why the stock has dropped so much. But even with that, it's partially true. It is true, but that affects every single financial asset, not just stocks, not just bonds. It affects real estate. It affects even commodity futures. Everything interest rates is embedded in. So it's not just the dominant reason. It is really overvaluing how much interest rates affected his stock. But something he can't control, whether you agree with him or not, his actions has affected the stock. His shenanigans with Twitter over the first 3 quarters of 2022 before he bought it, and then now he's offloaded an additional 20 million shares at mid-December, which is about 5% of his holdings, but he does hold a significant amount, which has further pressured the stock downwards. So his actions, as well as the views of people, so he's sold stocks, he's made obviously a ton of political opinions, which I'm not going to go into too much, but it has really put a dampening on many investors and as well as customers. So that's operational as well as financial side. Then third, perhaps the most important factor for the company itself is it is seeing a slowdown in operations. So just yesterday, the Q4 22 delivery report came out below expectations for both analysts as well as Tesla itself. Productions did grow dramatically, 47% year over year. But when you're pricing in these high growth rates, if it comes in even a bit short, investors start to get a bit skeptical, especially with what's been going on in the broader economic conditions in the market. And as well, production has outpaced delivery. So you may be wondering, why is that such a big deal? It means that they're starting to build up inventory, which means demand can be lower. That's not an absolute, but it does generally hint at it. So while the full earnings report is to be released on January 25th, which could result in another spike up or down, we will see. I think it's going to be quite volatile. It is now our dog of the week for now. And I'll open up to you guys if you have any comments.
Yeah, well, there's a few things. One thing I want to mention is that Tesla was one of the more highly valued stocks in 2021. And now if I'm going to look at analyst estimates, which, you really have to take these with a grain of salt, but analysts are estimating, I think, about $4 in earnings per share for the current year. And then for that to increase to $5.30 or almost $5.30 for next year. So doing the math on that, you're looking at about 21 times next year's expected earnings. Now, I expect these
ratcheted down probably.
They're going to be revised downwards almost certainly. I mean, analysts are very there's always some stickiness to revising the estimate downward because you're admitting that you were wrong in the first place, and it's just human nature. So I would expect those, but certainly, I mean, you're seeing a complete revaluation of the stock, right? One thing, and yeah, another thing is just the topic of Elon Musk. I mean, it really does seem over the last year he's really politicized his brand, which I don't think is a good idea for a CEO because you're especially in the United States. Now it's a global market for Teslas, but especially in the United States, when you politicize your brand, you're essentially turning away potentially 50% of your customers either way, right? So generally speaking, I don't think that it's a great idea. And you would think as well, with Tesla being an electric car company, there's the climate change aspect to it. You probably have more customers that tend to be from the left, I would think, in the United States. So, for that reason, some CEOs, I think the smart ones, just don't make their company about their personality. They make it about their product more. And then there's just a lot of things with how much of a CEO can he really be of Tesla when he's spending, it seems to be like most of his time on Twitter. So yeah, I can't imagine, with the economy potentially continuing to slow, rates remaining high, maybe they're not going to continue to go up. Maybe they'll even come down towards the end of the year, but still remaining high. And then a lot of competition coming online for electric vehicles. I wouldn't be necessarily in a hurry to jump in on Tesla stock right now. That's for sure. Even though the valuation does look a lot better than it was.
Yeah, I mean, I think it's ironic that social media, I think it's underpublicized how much it helped Elon Musk build Tesla. Like without having the expense of marketing, being able to have his massive following on there, just tweet out something using Twitter, for example, or put it out on another social platform and have hundreds of millions of, even billion people looking at that tweet without having to pay a single dime. It sets them apart from, Ford has to spend millions, billions for a Super Bowl ad to launch a product, for example, or something like that. And Tesla can tweet out something and it gets the same effect. And then it had a cult-like following of people who are following this cult of personality, right? And if you start to eat away at that, and he's eating away at that via his actions on Twitter, which is from social media. So it's ironic that now that could be, that's what's really sinking the stock. Valuations were what was crazy though, too, on the stock. And, you're starting to maybe get into a territory where they're starting to look better if you believe the growth going forward. But now do they, do they face more competition? Their
And that to
balance
me
sheet looks
is
a hell of a lot better than their competition, though. I would say that too. So we got to
yeah.
take that into fact. But
But
yeah,
I mean, as more car companies come out with other vehicles that like, I mean, Tesla had the cool factor. Now you see, because you didn't see many Teslas around, so you'd see a Tesla and it'd be like, oh my god, that person has a Tesla. It was a sign of status. Now you see more Teslas around, still a sign of status, I would say, but less so. But now you're going to see, BMW, some other electric vehicles. There's just going to be a lot more competition. So, CEO branding completely aside, I think that's probably would have been a major risk to Tesla anyways.
But there are people, say, in the last 6 months to year, maybe in the last 3 months more accelerating, that I don't want to own, saying these statements. I don't want to own Tesla because I don't like Elon Musk. And that wasn't
absolutely.
There 6 months to a year ago. I mean, there was a few.
His
but it's
brand was a positive,
more.
I'd say, 1 to 2 years ago.
And it probably still is overall, but you hurt that, right? And that's a factor. I mean, it is a factor because if you start to get like to like in cars, like if people start comparing Tesla's technology to, an electric car from a competitor, and it's like to like, then you need brand, right? And if your brand is getting tarnished, there is a hurt there to the overall.
Personally, I'd rather invest in a company where the CEO doesn't make it about his own personality.
Yeah.
For the most part, I just think that's just a more rational perspective because it should be more about the product.
If we look at the fundamentals, and if Tesla continues to grow at similar to the rate that it does now, and you can buy it for the price that you can, and it has a solid balance sheet, it is interesting. But you put that into doubt with the items we're going over right now. So I mean that's investing. It wouldn't be this.
I mean,
cheap
certainly if it starts hitting next year's targets
on a relative
the fundamentals
basis
look good, but
it's
it's still at around $100, then it starts to look interesting at that point. But we'll see.
Yeah, for sure, interesting, and we'll continue to monitor that throughout the year for sure. Now, you've got a star for us, totally obscure relative to Tesla. Well, many brands are, but this is a tiny microcap on the Canadian market. Ibex.
Well, that's why I went with it. I wanted that contrast. So me and Ryan were talking about this yesterday, and we were going. You mean
their CEO isn't out there, tweeting every 5 minutes about? It's a little.
And
different.
even if nobody would
care.
No one would care.
So he could be out there doing that.
Yeah. So I will preface this. This is about a $20 million market cap, and this is after what we've seen. So let's get into it. So the star of the week is Ibex Technology, symbol IBT on the TSX Venture Exchange. It is a biotechnology company specializing in manufacturing the enzymes, I should say. Ibex sells enzymes directly to third-party manufacturers for medical devices, quality control labs, no molecular weight, heparin manufacturing, and academic research institutions. The stock has jumped 58% over the past month and is currently trading at 76 cents a share. The jump in price can be partially attributed to its Q1 2023 release on the 21st of December, but it was starting to go up a bit before that. So really, what are we going into here? Earnings and revenue were effectively flat. So not great news, obviously. Normally when these small companies come around, you're expecting growth behind it, but no, that's not what happened here. But the thing is, weakness was expected, and Ibex initially during COVID, really benefited from the demand for hemostasis tests, which I probably am butchering half these pronunciations, by the way, so you can berate me in the comments. And hemostasis tests are important for COVID testing and hospitalization-related illnesses. So the demand for products has now dropped, causing headwinds for the top line, so that's being revenue. Additionally, the company is expecting weaker earnings due to its R&D spending for a diazamase line, another one of those hard words there. And together, these has effectively created a negative expectation of the stock. So when you're coming in flat with negative expectations, it's actually a good thing. So, and as well, this is a very small microcap. Like I said, it's the opposite of Tesla. And because of that, any news, even neutral news like this or relative positive news, can be seen as a great thing. And really, when it has a strong financial backing, it was featured in our cash rich report in 2022, as well as our Canadian growth and opportunity report, with this cash position of 8.2 million, which is over 40% of its market capitalization at its current, now higher price. So before it was 60, 70%, depending on the exact day and quarter. The cash position in the stock just gives such a good buffer for companies like this. So any news which can give any of these future growth opportunities really a pump up, like it did here, we're starting to see these stock price catalysts. And as well, when you're getting that low, you can start to see some acquisition, like what Ryan has previously predicted for a cash report in our previous podcast show. That might not happen, but for now, it is our star of the week.
And I just did a quick look at the financials here. So it looks like they've produced about 3.2 million in operating cash flow over the last 4 quarters. I mean, not bad. You take, that $19 million market cap, 8.2 million in cash, 3.2 million in cash flow. Not saying that it's a buy or anything, but at least there's something there to look at.
Exactly. Like, it's nothing big, but it's at least something there, unlike some microcaps this size. And Ryan is finally back. He disappeared for a second.
Yeah, sorry, I missed the last part of what you said there because my Mac, and I blame Brennan, just completely died in the middle of that. So sorry. I blame Brennan. Anyways, I know that diamase, which is an enzyme which targets persons suffering, I think, histamine intolerance, it's going to be marketed as a nutraceutical in their MD&A. I don't know if you mentioned this, but they said they're approaching an inflection point in the development of diamase, where if they continue expenses for research and production of the food grade finished product, it will significantly increase and have a negative impact. Expenses will increase, have a negative impact on profitability. So really good numbers. Growth, obviously, in the last quarter in terms of revenues, which is flat basically, and income was flat on a relative basis. The cash balance is really strong. No debt in this business, and cash just keeps increasing. So cash rich, relatively decent fundamentals, but it has moved up, and we expect probably, there's not a lot of guidance at all from management, and they really are nebulous on the terms of whether or not they can continue to grow going forward. So you're kind of flying in the dark a little bit with the business. I think that, it kind of just got recognized. I think that's why the market put it higher, bid up the stock. Now it's probably in a fair value range. If you start to see declining earnings for a number of reasons, then it might drop down again. Without guidance from management, it's hard to look forward on the business. Certainly a good balance sheet, building that up. Maybe somebody wants to buy the company at some point, but I didn't hear the last part of what your argument was on it. So, I mean, it's something in that, probably along those lines.
Yeah, right? Quite close. We did talk about this yesterday, but it's an interesting company. It's one which...
It certainly is, yeah. Produces cash flow, has a great balance sheet, and, has good earnings. Like, when it was trading at 30 cents, it really is, an opportunity there. But, again, management didn't have a ton of guidance going forward then. It was kind of a surprise to see the earnings jump over the course of this past year as they did. They may flatten out now, and there may have been some purchases pulled forward from some clients that maybe level off over the course of this year. But we'll continue to monitor them. Certainly an interesting little cash-rich microcap. I think that's going to end us off for this week. We're good.
We're good.
No other comments. Well, keep your questions coming in for our Your Stock, Our Take segments. If you want us to debate any stocks, send those in and we'll look at them. Keep your comments on YouTube. We'd love to see those there. We're going to comment more on those going into 2023. Again, I wish you all happy New Year. Smash that subscribe button and profitable investing. Thank you.
Thank you, everyone.
Thanks, everyone.
Thanks, everyone.